Again, everyone, welcome to the webinar tonight. I'm really happy to be joined today by Ryan Watts, founder of Red River Development. You guys know me. I'm Daniel Shin. I'm a physician and founder of Cereus Real Estate. So let's talk about Cottonwood Creek. These are disclaimers. I'm not going to read through all of them, but if you are interested in the deal, make sure to take a look at that. This is confidential information. And if you were to invest, there's obviously going to be some additional legalese to get through. All right, so let's go through the really quick executive summary, and then I'm going to hand it off to Ryan to really get into the meat and potatoes of this deal. This is a development deal. 206 units are going up in Waco, Texas. It's a shorter hold period than a lot of the value add multifamily deals that we run into here in Cereus Real Estate. And it's specifically called build to rent. So Ryan will go into that. And, these are the numbers. We are helping raise equity for the deal. There's also a debt component, and you can see the totals there. And through the collective leverage that we have as Cereus Real Estate, we've worked with Ryan and his team to offer really compelling projected returns for this investment. So if you were to go in as a Class B investor, you can see the totals on the left, and our targets are on the right there. So that's one of the advantages of coming through as a collective investment through a fund like Cereus Real Estate. So, just real quick in terms of investment timeline, we've kicked this deal off last Friday. We're doing the webinar today, and we've got about 3 weeks there for you to go through the deal, talk to me about questions, go through the paperwork, and start your investor account, go through the paperwork, and actually get moving towards a funding deadline next month. All right, so you've got time, but no time like the present to be getting going on all this stuff if you're really interested in making an investment before the allocation is full there. There are some fees that are inherent to investing as part of Cereus Real Estate. However, I want to make sure that you know that the projected returns for Cereus investors are net of fees, so it takes those into account already. Okay, and as I mentioned, Ryan Watts is joining us today, managing partner of Red River Development Group. They've got over 25 years of combined experience in ground up development. Really significant amount of capital that they've deployed towards building these communities in the past. And we're going to see a lot about their track record here, specifically in the build to rent space. You guys know me, but if you don't, I'm a board certified urologic surgeon. My background is in medicine, but over the last decade or so have really swung a lot of my attention towards real estate investing. And I created Cereus Real Estate to bring the opportunity of real estate investing to you. So I'm really happy to be here. Just real quick, why we love this deal: shorter deal duration, strong return profile, experienced vertically integrated sponsor. Ryan's going to talk about that. They recently validated their exit thesis in their Jenks deal. And as you can see here on the slide, Waco's a really booming place. We'll talk about the location and the geographic blessings that it affords, and they've already broken site, which takes broken ground, that is, which takes away so much of the risk of these traditional development deals. All right. Okay, so I'm going to hand it over to Ryan to really kick it off here and talk to us about these slides. Ryan, just feel free to prompt me when you're ready for the next one, okay?
Sounds great. No, thank you, Daniel, and good to be with you all. Yeah, just talking here in general about what's driving build to rent. What are kind of the fundamentals behind our investment thesis, and probably not new news to anybody on the call here, but we have a housing shortage in the United States. We're not building enough homes. We're not, and especially not enough starter homes. And so you've really got an affordability gap that exists today. That's typically 1,500 to 2,000 a month. Is about the delta that we see between our product and the cost of owning a home. And so we see this as kind of part of the missing middle, if you will, to really help address some of the housing shortages that we have and the desire for a differentiated product type. So some of the kind of key things about build to rent, this is a purpose-built for rent community. We have 206 homes in this community. And our goal really is to provide our residents the best of both worlds between the amenities of a Class A apartment community, high-end apartment community, and then a home that lives like a new home. I mean, it is a new home. It's got a private backyard. We cover all the maintenance. And so, we like to say it's really almost a resort style experience for our residents, and we found that they really love that.
Yeah, I think especially in Texas, that pool's gonna get a lot of usage, right, with the weather.
There's no doubt. Yeah. Texas summers get hot. Texas summers get hot. And we see, and we will talk more about the Waco market, but really in all of our communities, we see kind of two ends of the barbell. A lot of young professionals that are transitioning out of apartments, tired of apartment living, want something that lives more like a home, but not ready to buy a house yet. And then we see a lot of folks on the other end that are older that don't want to own a home, don't need to own a home anymore. They love the kind of resort style living aspects of our communities. We handle all the maintenance, we mow the yard front and back. It's a great experience for the residents. And then certainly we'll see a good student population in Waco too, I believe. Yeah, so some of the big benefits that we see, and there's another slide here that does a good job of explaining it, following up to this, but the premiums that we get over Class A apartment communities are usually 20% plus on a per unit basis, and can be as much as 40% on a price per foot basis. And so we see a lot stickier tenants, or our residents stay longer, and we generally produce better occupancy, and I think the renter profile from an income standpoint is stronger in the built to rent product. Yeah, here's some stats that kind of drive that home. So when you see 64% renewal rates, 10 percentage points higher than multi, and we see even better in some of our communities than that. Strong rent growth. I think you've got a differentiated product, and so you really have the ability to push rents in a greater way than you do multifamily. And for this project specifically, we're the first kind of horizontal style, cottage style built to rent product in the market, and so I think that's going to make us very differentiated. And then you see higher occupancy rates, almost 50% higher occupancy rates in BTR than you do traditional multifamily. Just less turnover, less people leaving out the back door, and so you really see stronger occupancy here. So all three of those big reasons why we love built to rent.
And I think these are national kind of averages, but we'll see some numbers specific to your communities also in later slides.
Yes. Um, I mentioned this point earlier, but the higher average incomes of our residents, we've got a lot of older residents, as I mentioned, folks that are young professionals that are transitioning, maybe they're starting a family and are all making good incomes. So we see that is a real benefit of built to rent, and we own multifamily too, and I like multifamily, but we certainly experience more turnover issues and not as strong a resident profile there. We've seen it kind of firsthand.
All right. And then maybe you can just tell us a little bit more about your team here.
Yeah, I'm happy to. So as you mentioned, earlier, Daniel, I co-founded the business. I'm managing partner of Red River Development. Founded the business alongside two partners, Jay Dempsey and Stephen Watts. Jay's got a background in senior living, built a company called Civitas Senior Living. They did more than $1 billion in ground up development on the senior side, and very successful enterprise there, and still ongoing. My brother Stephen Watts has a background in construction and multifamily development, and so Jay and I were investing in some of Stephen's multifamily deals back in 17 and 18. And we were talking about build to rent as an asset class and about how that was something we would like to invest behind. Um, we ultimately said, hey, let's form Red River Development to do that and to be that investment vehicle. I had a background in investment management, had an oil and gas investment firm for 10 years, raised private investment vehicles to go out and acquire oil and gas royalties. And then we sold that to a public royalty company in 2020. And so my brother and I had a lifelong dream of kind of doing a business together, and we believed in this build to rent concept. And so fast forward to today, we've got these numbers are a little sweet stale. We've closed a few deals here in the last month, so we're up over 700 million in AUM and more than 200 million in equity invested. The unit count's about 2,300 today. So we are it's been a fun business to build, and we're excited about continuing to grow it.
All right. I think this is kind of the comprehensive portfolio going back, to encompass the senior living as well.
That's right. Yeah. That just speaks to our experience with development. More than 1.3 billion in total project costs, 5,200 units, so a little bit more. So we're very comfortable and experienced in the space.
All right. And here's some specifics about the build to rent.
Yeah. So these are the our six build to rent communities, kind of in the order in which they were developed. So I think you mentioned this earlier, but we just exited Trula Homes Jenks. That's in the Tulsa, Oklahoma market in January. And then Quail Village and Twin Creeks in Oklahoma City and Kansas City, respectively. Both of those stabilized, performing well. Very high occupancies, especially in Kansas City. I think we only have one available unit for rent there. So we're 97, 98%, 94, 95 in Oklahoma City. Terra Ridge and Bridal Creek and Bentonville and Whitestown, Indianapolis, respectively, are in the late stages of lease up, and will stabilize this summer. So very 80, 89, 80, 90% and trending at 94, 95. And then Trula Homes Stone Ridge in Centerville, Ohio, is our sixth build to rent project. We broke ground on that last year. That's between Dayton and Cincinnati, and we're looking to deliver the first phase there in later this summer.
Okay, perfect. So the first five on the left, from the left side, are all completed, and Trilla Stone Ridge on the immediate right side, that's still under construction then, just to summarize.
That's correct. Yeah.
Okay, perfect. All right. And so I included some of these beautiful photos of your communities here. Maybe you can go into that.
Yeah. Happy to. So, as I mentioned, we want to provide that great amenity set of a Class A apartment community. And so we have always got a resort style pool. These are gated, very well equipped fitness center. It's open 24 hours. We've got a clubhouse, which is kind of our amenity center that we've got, good co-working space and workspace in there for folks that need it. A lot of dog parks. Every home has their own private backyard. And again, we take care of the maintenance of the yard front and back, handle all that. We have an on-site maintenance team. We're going to have pickleball here in Waco, which I think will be a nice amenity as well. And then, 1, 2, and 3 bedroom options.
Excellent.
Yeah, and then here you just got some imagery of our communities. This one happens to be in Kansas City. That's the Twin Creeks community. So you can see kind of how the units are set up, how the backyards look. We've got in this case, and we'll do this in Waco too. We do duplex the one bedrooms, so there's a wall between them, but then the two and three are always standalone. So. Yeah, good picture there. And then here you've got on top a look at the kind of clubhouse amenity center for our community in Kansas City, and then below that you'll see the interiors of the units.
Okay, perfect. So we're kind of moving on now to talking about Waco. And, I had not been to Waco, Texas before, but last week I flew out there. I sent out some of that footage to the investors over the weekend. And just we'll talk a little bit about the location, but I didn't realize it. It's in this really interesting region, kind of flanked by the three powerhouse cities in Texas of Dallas, Austin, and Houston, I believe. So it's really nicely situated right in the path of this enormous growth and development.
Yeah, that's exactly right. So we call that the Texas Triangle down here in Dallas, and yeah, Waco's squarely in the middle. It's a really strong market. It's halfway between Austin and Dallas, so it definitely drafts off of those markets. And really with a strong regional base, you got Temple Belton nearby, and then Waco. So 874,000 in that kind of regional area, and some very strong demographic factors as you look at this site on the bottom left as compared to the national benchmarks. Those are some of the key demographic criteria that we have when we look at site selection, and this site stacks up especially well. So some good some of the growth drivers and employment drivers in Waco. We mentioned Baylor University; they're the largest employer, huge driver. Both from an employment standpoint, but also just sort of culturally. They do great developments all around the city. Things that are associated with the university. You've got two great hospitals in Waco, large hospitals, regional medical centers. We get a big manufacturing and logistics base, so about 1.7 million times, or I'm sorry, 1.7 times the national average in those industries. A lot of it due to its location, I think, and proximity, and being kind of right in the heart of that Texas Triangle. So, and there's a business park that's just south of us, 5 minute drive, where a lot of these companies are located. So we think that'll be a great demand driver for us. Some good military employment around here. There's three Air Force bases. L3 Harris has a big, or three Air Forces. There's a big military base, Fort Hood. It's not far. So, a lot of defense as well.
All right. Yeah. What I'm seeing here is just what you said. So, better household growth than national benchmarks, better income growth than national benchmarks, better median income. So, a lot of nice things happening in Waco. Here's some nice photos.
Yeah, yeah, just some imagery. Another driver that we see in Waco is tourism. And so if you look at the top left, that's the Magnolia Silos development in downtown Waco that is to Chip and Joanna Gaines, who you may know from HGTV fame, but they're great ambassadors for Waco and have developed some really cool stuff in town and contribute a lot culturally to some of the neat stuff going on there. Yeah, and look at a couple of things that the university's doing. They just built a brand new basketball arena in downtown Waco, right on the river. That's the top image, and that kind of ties Baylor's campus, which is east of 35, into downtown, which is west of 35. So that's a super cool development, and is doing very very well as a venue, and another big attraction for downtown Waco, and a lot of new construction on the campus too. Foster Pavilion is shown below, and great football arena that they built. That was probably 10 years ago, but it's first class.
Yeah, I drove through the Baylor campus and it was thriving, and I've got this sort of theory that top tier universities are just a hidden weapon for development and things like that. In this century, some of the middle and lower tier may not cut it, but the top tier universities certainly are big development drivers.
Yeah, so talking here about some of the fundamentals in the market, you can see there's been a lot of capital invested here. I mentioned a lot of the manufacturing, which is what you're seeing here. SpaceX has a facility that's very nearby, 20 minutes away. So they're also a big driver in the area. So you've seen strong rent growth, and just a ton of the tailwinds that you see. That are happening in Texas, and specifically that Texas Triangle, Waco is really benefiting from.
All right, so I think we're getting to the meat of the presentation here, talking about the project itself. So, all right, here you go.
Yeah. That's a look at our community in Jenks, kind of the clubhouse and the units there behind the gate. So, again, this is our seventh build to rent community. So a little bit of kind of rinse and repeat here. All very similar, same floor plans, same style. So yeah, excited to get this one going.
All right. And I think the things to pick out from here, 20-acre site, just 4 miles from Baylor University. So there'll probably be some student population taking advantage of your community there. Um, and yeah, here's some maps.
Yeah, yeah. So this kind of shows exactly where in Waco the site is. You can see there to the north, west of 35 is downtown. Yeah, about a 7-8 minute drive from our site. Baylor University, about the same. They're just east of 35. So very well located, and really a tremendous built to rent site for this market. Yeah, and here's a zoomed in look at it, and you can kind of see why we found this site to be so attractive. We purchased this from a retail developer that sort of master planned and developed this whole kind of entertainment district here in Waco. So just a ton of great walkable amenities for our residents. You've got Top Golf right across the street. You got Cinemark movie theater, main event, a bunch of restaurants nearby and walkable. So we love that aspect of this site to be able to provide that many kind of amenities to our residents that are walkable like that.
And I can attest that Chick-fil-A is up and running already. It's one of
Busy
the first
drive.
thing I noticed.
Yeah,
What's that?
it's a busy drive-through over there.
Oh yeah, it always is. Love Chick-fil-A.
Yeah. Yeah, so this is a look at kind of total project budget. Again, 206 homes, 56 one bedrooms, 78 twos, 72 threes. Very similar unit mix to what we've done previously. 23-month construction period. Although, as you noted earlier, investors that are coming in today are shaving 2 months off that period. So that's going to help returns certainly for investors. And then, good construction budget with a 65% loan to cost construction loan here. So a nice conservative capital structure, which we think is important. We don't want to put a bunch of high leverage debt on projects like this because then if you do that, everything has to go right or else you get in trouble. And so we're certainly conscious of that capital structure and feel like that's a big, downside protector for investors.
Yeah, and
Uh,
this is about the debt specifically here.
yeah. So, yeah, good look at the debt terms here. We do personally guarantee the debt, so we're very much aligned with investors in terms of seeing this project be successful and perform. It's a 5-year term, 3 years interest only, and then a 2-year extension period where it's principal and interest on a 30-year amortization, and we get a little bit of a step down in the rate on the extension.
All right. And I just wanted to show this slide a little bit and just note the timeline. So the year one is that's actual operations when you're functioning as a stabilized community, right? Because that's in 2027, late 2027. Is that correct?
That's right. Yeah, we'll deliver units in 27. We'll get most of the units delivered in 2027. And we may be hitting on this later in the presentation, but I'll just mention it here now. Important for investors to understand there's a big depreciation benefit when it comes to new construction, new development like this. The OBBB bill made permanent the cost segregation, accelerated depreciation, 100% accelerated depreciation. So 2027 will be a big year. I would expect an investor to get, their total investment amount back in tax deductions. And I think, 80% of that's likely to come in 2027. So important to note. But yeah, as far as the operations numbers here go, consistent with what we've seen in our other communities on operating expenses, and feel like these are reasonable NOI projections.
Okay, so a couple of differences I wanted to just point out to our investors that is a little different. So in a value add deal, that first year K1 typically has most year depreciation. It's a little bit more delayed in this deal, just because most of their construction will be in 2027, as Ryan said. Secondly, the cash flow component is from the year of stabilization onwards. So that's another little difference where typically in a value add deal, you might expect cash flow from month 3, month 6, or something like that. But it's pushed out a little bit because they have to build the units first and then stabilize them, as in get it leased up before that cash starts flowing. Do I have that right, Ryan?
That's exactly right. Yeah, Daniel.
All right.
Yeah, and I referenced this earlier in the presentation, but we've seen these rent premiums over new build Class A multifamily bear out across our portfolio. You can see property by property with our operating communities how this premium is played out. And so again, about 20% on a per unit basis and close to 40% on a price per foot basis. So I think it just goes to show residents are willing to pay, a premium, a couple $100 a month more to get something that lives like a new home, and they're willing to, make that trade all day long.
Yeah, and I think this is actually one of the key things that attracted me to the deal, honestly. And I know this is small, so I encourage investors to download the actual deck from the deal room. But this is their experience across their actual communities that they built. And you can see on average, they're getting about a 20% premium to Class A multifamily. So Class A multifamily is typically held up as the highest sort of rent you can get in multifamily, but this is showing that there is another tier, which I didn't know about before, and that seems to be the build to rent from Red River. So I think this is a powerful slide here.
Yeah, and this is probably a better look at it when you really dive in property by property. But the same story here. These are the average premiums from our operating communities today.
All right. And this is the current status. They were very busy out there moving a lot of dirt around. And as Ryan mentioned, this is effectively shaving off 2 months from the deal cycle because they're already 2 months into it already. So taking off so much of that initial risk. I think most people are scared of development because you can commit money to a development deal and then that zoning and negotiating with the city can drag on forever. And in this case, they've already done the hard work. They've taken that risk off the table. So I just want to point that out. Oh, and here's just a little opportunity, Ryan, for you to talk a little bit about the Trullo Homes aspect of your company.
Yeah, yeah. So Trullo Homes, that's our built to rent brand. So if you Google Trullo Homes, that's our resident facing brand. We manage all the communities ourselves. We're Red River Development. We're on both sides of the Red River. We've got a office in Tulsa, Oklahoma, where my brother lives, and my partner, and then we have an office here in Dallas. And so obviously we'll service this out of Dallas office from a team standpoint. But we think this is a great alignment of interest. It has us very focused on execution, both getting the lease up, stabilization, and we've been a first mover or a fast mover in what we think are strong secondary markets that are underinvested, and it can be hard to find good property management in a lot of these places, and so we elected to build this ourselves and to really build a brand that can have some name recognition and help residents understand what they're getting with a True home.
Okay, so just wanted to spend a few minutes kind of reiterating target returns. And obviously, these are projected. And, as opposed to a value add deal where the asset is already kind of sitting there and you're just kind of improving it, Red River is actually building these units. There's some good questions that came to us already that we'll address in the Q&A in just a couple of minutes about, how they're going to control costs and things like that. But you can see that the 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 risk reward is balanced because these are significantly higher projected returns than you would expect from a typical value add deal. So I always talk about how you have to risk capital to get a reward, and in this case, there's a perhaps a little bit more risk with development, but we are going for a shorter timeline and a typically higher reward profile. So just wanted to talk about that. We do have some people who joined us recently, so I just wanted to go over the timeline real quick before we skip to Q&A here. These talk about some of the fees that you would expect investing into the deal, but just to say again, the return projections take those fees into account already. So what you see is what you get. And we're going for a fairly tight timeline here, but we've got just about 4 weeks for you to review the deal. Talk to me if you want to, go through the deck, complete paperwork and your investor information on the investor portal, and then get your funds transferred. Okay. All right. And then next steps here. So take a screenshot if you want of this. Obviously, this is available in a number of places, but there's the link QR code there to submit a soft commit. We've had significant interest in the deal already, and feel free to book a call with me. I practice about quarter time now because I am devoting the majority of my time to serious real estate, and that means I have time to chat. So feel free to arrange a call with me at your convenience. Um, so let's go to question and answer a little bit. I'm going to stop sharing the screen here and check the Q&A section, but I've already got a few questions that came through. So while I'm doing that, maybe I'll throw one your way, Ryan. So the first one really is about returns. So in a development deal, how are you projecting returns? And how would you say your experience with, for example, the Jenks deal validates your projections?
Yeah, so our return projections when it comes to looking at that, it's driven by cap rates. Certainly, we experienced about a 5.6 cap, 5.6, 5.7 cap. I think we're underwriting a 5.5 cap here, which I would expect Texas to be a little lower than Oklahoma, but certainly not as low as Dallas. So I feel like that's a realistic kind of underwriting metric. And then really it's about delivering that NOI and executing on the lease up in a good way and hitting that target NOI, which we feel good about here.
Let me translate that just a little bit. So capitalization rate for some of our newer investors is basically the way that industry prices how much to pay for a real estate property, typically multifamily when you're talking about cap rates. And it's essentially like a multiplier. So if you talk about the valuation of Tesla, it's maybe a 500x valuation to its NOI, net operative income, or something like that, which is really high, right? But for a dry cleaner, it might be 4x or something like that. So, capitalization rate is another way of expressing that formula in reference to real estate. So when Ryan says a 5.5% cap rate, that is based on data, what is expected to be had for an asset of this quality. And in reference to your Jenks property, which recently closed, I believe you told me that it was a 5.6% cap rate. Is that correct?
That's right. That's correct. Yeah. Yeah. And we saw, a lot of there's a lot of institutional demand for this asset class when you look at long-term owners of built to rent assets like this. And we saw I would expect that those guys have already expressed to us that they would like to buy more. And so this, what I would say is there's a deep capital pool for this asset type, and a lot of folks are looking to acquire it.
So basically came in on target. And who are the typical buyers of huge, communities like this? Who can afford to buy a 200 unit, class A community like this?
Yeah, yeah, yeah. Well, the group that bought our deal in Jenks is called Griffin Capital. They're a large institutional multifamily owner that has expanded into built to rent. But you've seen a lot, there's a lot of public companies, Invitation Homes, Welltower, um, that could be, sort of more strategic type buyers. And then, just a deep pool of, kind of core multifamily buyers that want long-term cash flow from a stabilized asset like this. It's a class A asset.
Okay. And as we're talking, attendees, participants, feel free to put questions into the Q&A. You should be able to do that. Um, all right, so let's get through some more of these questions here. So I think we went through this next one here. But how do you stay on budget in terms of a 200 unit construction project? I mean, I can imagine a lot of things can cause fluctuations, but obviously your experience. So how do you control costs?
Yeah, sure. Great question. So this is our seventh community. We've certainly, learned a lot, over those other six communities. I think I've gotten this, down to a pretty good place. But the key is to really have a strong general contractor that's a construction partner who's got deep experience and also they can provide a guaranteed max price contract and is willing to stand behind that. And so that's what we have here. The GC is called LMF Construction. They're based in Dallas, and have a GMP in place. And again, one of the advantages of coming in at the stage that you're in is they've already signed all the agreements with the subcontractors. We've signed the GMP contract with them. We're under construction, so there's no. We bought out the materials, so there's really just not a lot of places for the price to move at this point. So that's the key for us.
Yeah, I would expect the investors to find that pretty reassuring. So guaranteed max price contract. Perfect. All right. So I guess I think you addressed this next one, but just to reiterate, I know how are the other communities going? You've already talked about how you're really commanding a significant rent premium as your data shows. But how's the experience been in terms of resident satisfaction and retention in these other communities?
Yeah, it's been strong. I mean, we see, we touched on renewal rates being higher. Our residents do stay longer. We see 65% plus. We're some communities were at 70% plus, which is really strong. And just having a differentiated product, being able to command those rent premiums that we do, I think being able to grow rents in a greater way. So we've seen really good performance from our stabilized communities.
Yeah, and that is really strong. I think industry standard is what, 50% retention. So, I mean, being able to hold on 65% of your lease renewals is very strong. Daniel Thompson is asking a great question that is actually perfectly aligned. So the question is about exit strategy. So obviously, there are we live in an uncertain world. What happens if we need to kind of go past the projected timeline? What does that do to the loan? And then what would happen in that circumstance?
Yeah, so it's a great question, and a couple of things there. As far as the loan's concerned, it's a 5-year loan. 3 years interest only. There's a 2-year period with where it's principal and interest on a 30-year AM. But the reality is, once we get it stabilized, there's a lot of sort of lower rate debt options if we wanted to refinance it and maybe look to make distributions. The reality is we'll look up once we're getting close to stabilization and kind of see, hey, what does this market look like? What do we think we can exit for? One of the benefits that I see investing today is um, new starts are down 60 to 70%. So there's not a lot of stuff coming out of the ground. There's been a big supply wave that hit from all that construction that happened in 20 and 21 and 22 and even in 23. And the interest rates came up and a lot of the construction really slowed down. And so I think we're going to be delivering into a really strong or supply demand environment. When you look ahead with numbers down as much as they are, so I think that's a real benefit here, versus the market we see today, which is a functional market, but I think is very much a kind of a show me performance based market. And back in 21 and 22, you saw a lot of buyers that were willing to just purchase these things on a forward basis and certificate of occupancy. That's not the case today, but it could be the case in a few years. So, but in terms of that strategy, hey, what does it look like when we get to stabilization? And then if we don't like the market, if it's not going the way we want it, if something's off, it's taking longer to lease it up than we thought. We something bad has happened in the market. We don't think valuations are right. With the conservative capital structure we have, we can just refinance it and cash flow it and just make distributions. That's kind of the downside plan, and because we don't have a lot of leverage, it's easy to do that.
Okay, great. So great answer. I think the question came up because in the formal plan, I think it calls for a refinance around the 38-month mark or something like that, and then a sale pretty soon after that,
Yeah.
around month 42 or something like that. So about 3.5 years from, now to the projected finish. Um, where does where did that decision making come in terms of that timeline? And then what happens if it doesn't sell, um, you know, at that market? What does that do to returns, et cetera? What do you think is going to happen in that circumstance?
Yeah. I think the refinance just allows us to make more distributions to investors, and to generate more free cash flow. So that's the thinking there. And then, if it doesn't hit, then you could drag the IRR a little bit. But I think the trade-off to that as well, it's probably going to increase the investment multiple, the multiple on invested capital. So that's just kind of a calculus we've got to make about, like, hey, do we think it's the right decision for us and our partners to exit at that month 43 mark that we've modeled? That's what we've underwritten, but you know, uh, probably nobody hits perfectly on everything in underwriting. And so if it takes a little bit longer than that, we have a structure that allows us to be patient.
Yeah. So just to kind of break that down a little bit for the investors here, uh, IRR, internal rate of return is essentially you can think of it like a compounded return. So if you add time to the deal timeline, that can reduce the internal rate of return, but you're getting more money back because you're getting cash flow back. So that could increase your equity multiple. So everything's kind of a balance there. Um, all right. So Bilal, just wanted to ask again, when is construction expected to finish?
Yeah, we get a 23-month construction period. So yeah, we started about 2 months ago. So yeah, 21 months from now.
Perfect. All right, and this is a great question, a little more experiential. So obviously, nothing goes 100% right across 7 deals now, built to rent communities. So, what was the worst thing that you can recall that has happened along the way, if you wouldn't mind sharing, and then how did you kind of address that and learn from it?
Yeah, yeah. One thing that comes to mind that we dealt with a lot in Tulsa and even in multiple other subsequent communities. One of the challenges with this type of construction, these homes are pretty close together, right? This is pretty dense. They're 10, 11 homes to the acre. So we learned a lot of lessons about having a really tight civil engineering plan because we ended up with a lot of pooled water. We had to install drainage after the fact in some of the backyards, in some of the common areas, and so we really, over time, have gotten a lot better at like the civil design and the grading plans that are very important in this product type. I think our team's just gotten better too, both in terms of just the experience, being able to execute the construction process, but also the lease up process and kind of our property management team improving, understanding, who's our target resident, who are we trying to appeal to, how do you really sell this and position it because it is a little bit different than traditional apartments. So those are a couple of things that we learned.
Okay, perfect. And last question I've got here, and we've got a few more minutes, so feel free to stick more questions in the Q&A, guys, if you have. We probably have time for one or two more here. But last question I've got prepared is Waco. That this will be your only community in Waco, after it's completed. Does that pose problems, when you've got your property management operations spread out across, multiple different states and locations? How do you handle that logistically?
Yeah, yeah, yeah. So, for this region that we're in, and I think Waco's in this region, we have an office here in Dallas, and an office in Tulsa, Oklahoma. So, we feel really good about, being, hour and 20 minutes, from Waco, being able to cover that with our team here. We have an on-site regional manager that's based in Dallas. So being able to cover Waco, is not a challenge for us. And then we cover everything else kind of regionally so that, we've got Kansas City that's 3 hours from Tulsa, Bentonville's 2 hours from Tulsa, Oklahoma City's an hour and a half. So we cover that pretty well. In Indiana and Ohio, we have a development partner who's based in Indianapolis, and they have helped give us boots on the ground in that region in Indiana and Ohio, and have been a good partner for us. They've also built for us up there. So that's kind of how we think about it. I mean, it is regional, but we have definitely feel like given our footprint, have the ability to cover the Waco market.
Perfect. And I've been, as a bonus to the investors who are still on the call, we've got a bunch of you actually. I'll be visiting the Indianapolis adjacent development later this week with Ryan. So I'm really eager to see a finished community. I'm going to obviously be sharing that footage with everyone, but you'll have a sort of an inside view into some of their work. So I'm really looking forward to that.
Yeah, I'm as well.
Okay. Well, thank you so much, everyone. Thank you, Ryan, for joining us tonight to tell us about the Cottonwood Creek development. Really excited about this deal. Investors, feel free to reach out to me as always, and get those soft commits in if you're thinking about it. Okay, I think this one is going to be pretty popular. Thanks so much, everyone.
Thank you, Daniel.
All
Thanks,
right,
man.
everyone, have a good night.